Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, it's been just over a week since the NIF, or National Investment Fund's bond offering, has become open to the public, and significant investor interest has been generated both from an institutional level as well as an individual investor level. Now, a lot of the interest has come not about the returns, which seem to be relatively attractive given what's available in the market, but more about the perceived risk and what could go wrong or what may go wrong with these particular bonds. So let's take a look at some of the major questions that have been asked so far. Now, most of the questions are around three particular points. One, will higher interest rates affect my NIF bond prices? Secondly, will I be able to quickly sell my NIF bonds if I need to, and that refers to liquidity? And thirdly, can NIF comfortably repay the debt, the principal and interest related to the bonds being issued? All good questions. Let's take a look first at the interest rate and liquidity questions in particular. And with respect to interest rates, well, typically as interest rates go up, bond prices go down, and vice versa. A decrease in interest rates brings about an increase in bond prices, holding all other factors constant. Now, this may be of some concern to investors given the recent increase by the central bank in the repo rate, monetary policy rate from 4.75% to 5%. But that should be a concern to investors who may or have a very high probability of selling their bonds before maturity. For investors who do not intend to sell their bonds before maturity, interest rate risk really is should be very low on your list of concerns. Now, adding some price support, or what we perceive as some price support to the NIF bonds, is the fact that there will be reasonably wide buyer appeal across all the tranches. The tax-exempt status, which makes it very attractive relative to other taxable alternative options in the bond investing environment, and potential oversubscription as well. Turning to liquidity, the bonds have several factors which should enhance liquidity, primarily being the exchange listing, the fact that they will be listed on the Trinidad and Tobago Stock Exchange's corporate bond platform. Again, potential oversubscription can lead to some support and increased liquidity. The tax-exempt status and wide buyer appeal should also facilitate some increased measures of liquidity. Now, those are the two less of the questions. The more important question on the minds of investors is, how safe are these bonds? Can my principal and interest be repaid comfortably? Now, let's take a look at the overall story. Is default risk significant with the NIF bonds? Well, CARICRIS says that the bonds have a very high credit rating, and they are rated CARI AA-, which is one of the highest credit ratings that can be assigned by our regional rating agency. The asset value to loan value is nearly 2 times, meaning that for every $1 of bonds issued, there are $2 worth of assets in the fund, which can be used to generate cash flows, one, and also in the event of need for sale, they can be sold as well. And the expected annual cash flow, speaking of cash flow, is around $370 million, which is reasonably healthy. And why is that reasonably healthy? Well, at Bourse, we took a deeper dive from just the story into more of the numbers to estimate what the projected refinancing requirements would be for this bond under different scenarios. And as we focus at year 20, what the ultimate refinancing requirements might be, we see that there's a range of just a low of around $63 million in that very small blue column there, to a high of about 360 million TT dollars at the other end of our refinancing scenario. Now, what does that mean? Well, it means that based on our assumptions at year 20, the NIF may need to sell just around 0.8% of the value of the assets in the fund to as high as 4.5% of the value of the assets in the fund, which we consider to be a very minor risk, given the quality and quantum of assets and expected cash flows in the fund. Speaking of the quality of assets in the fund, if we take a look historically over the past 4 years, in terms of asset values of the components in the fund, we see that it's consistently been hovering around that $8 billion mark. So not much volatility in the value of the assets. Indeed, RFHL, or Republic Financial Holdings, and TGU make up the majority by asset and cash flow for the fund's value. Now, it's a lot to digest in a 5-minute period. If you'd like to get more information about the NIF, you can check out all of our articles on our website, or you can tune into our webinar tomorrow, July 24th at 2 p.m. Check out our Bourse Securities Limited Facebook page or give us a call at 226-8773 to get your invitation to this webinar. Again, just to conclude, we view the refinancing risk, that is having to issue additional bonds at some point in time, as very likely, but the risk of default to be on the lower end of the spectrum. That's it for this week's edition. For more information, again, here's the details. Have yourselves a wonderful week. This has been the Bourse Report.